It's Friday, February 5th, and you are about to go on the markets with Fermata Advisors. My name's Dano Weir. I'm the marketing director, joined soon by our marketing principals and our managing principals. Let's give them the right title there. And today we're looking at what crypto today may be telling us about 2026 tomorrow, or even 2026 right now when it comes to other asset classes. If you know a crypto maximalist, give them a hug today, check in on them, send them a text. We got to look at Bitcoin's all-time drawdowns after a rough week for crypto. Google's looking at record spending this year, what that could mean for AI. Real estate continues to be topsy-turvy. Would you believe resale homes are outpricing new homes? Let's start.
The stock market, the economy, your money. What's the latest and what could be next? Find out now with Fermata on the markets. Straightforward financial market updates for the brands of Fermata Advisors, Sonoma Wealth Advisors, Fermata 401k, and Fermata Tax. On the markets starts now.
Managing principals of Fermata Advisors and our private wealth brand, Sonoma Wealth, Daren Blonski, CFP, Chris Sipes, CFP. Guys, welcome to the show. It's good to see you.
How's it going?
Great to be here. Happy Friday.
Chris, so you're really starting with Elon Musk. That's what we're starting with?
I hate to get all philosophical.
That was so good. Dude, this post was I picked this thing out yesterday, and I was talking to this random dude. I'm like, if the richest dude in the world is posting money can't buy happiness, dude, that tells you so.
See, Daren, that's why we get along so well, because that's exactly what I thought when I saw this. I was like, because when I think it was last week, we showed the richest people of all time, like as a percentage of GDP, essentially, like adjusted for today's dollars. And Elon is not only a rich person, he is the richest person, the richest human to ever live on the planet. And for him to say this, it's true. There's no way you could say, well, yeah, but if you just overtook that next person, like maybe you would find that happiness you've been looking for. For him to post this, I thought it was really profound from a philosophical level. And it's a good reminder that we talk so much about maximizing wealth, and that means all forms of wealth, and especially the ones that are the most important, the moments that we have with the people that we care about and that care about us, and the moments you remember for your lifetime, those types of things. Trying to maximize those for ourselves is true wealth, and it's not necessarily about money, because as the richest human in history will tell you, money will not make you happy.
And yet, I just feel like these guys are all so boring. He's the trillionaire and he decided to make a car. Snooze. You could have found Atlantis, bro. Like, we could be hunting the Yeti. We could be digging up shipwrecks. I mean, there's some exciting stuff that we could be paying for, and he just chooses to do boring things.
Well, he lands rockets backwards. That's pretty cool.
All right. That's one. I'll give him that.
Save human civilization, right? I mean, that's boring.
Yeah. It is interesting, though. I forget who had the concept of, like, there's like a window of having enough money to equate to freedom to kind of do what you want. And funny enough, there's actually a ceiling on that, because once you get too much money, and or your money is tied to things that actually don't give you freedom, like say you're running a company like you are, like Elon, plus he's a public figure, that freedom is actually gone, despite the fact that you have so much money. Anyway,
well,
hate to get all philosophical so early on a Friday morning.
Well, you and I have talked about this, Chris, and I think it's an important point, because there is this, like, we talk about wealth, right? We're a wealth manager. That's what we do as a job. And there's almost this, like, wealth of privacy, which is a total new concept in a lot of ways.
Yeah.
And whether or not you can have a life that is private is actually a form of wealth now. And I think that, I don't know, but I'm projecting perhaps, but maybe that's what Elon's talking about. Like, I mean, think about the guy's life. Like, he can't do anything without it being completely scrutinized in every form or fashion. Now, let's be fair. He invites a lot of that scrutiny with some of the weird stuff he does and the people he associates with. But either way, like, it's still like there is a wealth to privacy. And that's true. I was talking to a client who's in intelligence, and I asked, is anything really private anymore? And his response was absolutely not. Everything you have on the internet is accessible, whether it's your phone, whether it's your Facebook, whether it's your whatever. We can look at all the information if we have the right clearances. And I was just like, oh, okay.
Write it on a piece of paper, put it in a safe with your jewelry.
Yeah.
Right. Yeah. A good segue there, Dan. This is from Liz Ann Saunders with gold making the runs that it has here lately. We've been talking a lot about gold, and I found this very surprising. This is showing that jewelry makes up almost half of all the above ground gold reserves, more than twice what central banks hold. So interesting. Central banks at 18% of gold holdings, while jewelry is at 44%. And bars and coins actually much higher than I would have expected too, at 23% versus central bank holdings. So interesting little tidbit there from Liz Ann Saunders.
Now we're looking at a meme here, Chris, and it says, Daren, is it hodling or hodling? How do I say that right? Hodling. It has the word on a tombstone, and for those who don't get this joke, what does it mean?
Well, as with everything in Bitcoin, it changes so fast that it's almost like not even relevant, because I put this in here yesterday, and of course today Bitcoin's rallying pretty hard. But hodling, from my understanding, is like you just hold on to your Bitcoin no matter what. And I think it originated from somebody like misspelling it. If
trying to spell hold, and then they spelled, it was a typo, and now
hodl,
it's like
yeah,
it means that you're holding your Bitcoin, you're not selling it.
I don't know. If that's not right, please don't come after me. I don't care that much. I'm just, that's my understanding of it. But Bitcoin's had this big pullback, in the last few weeks. And so yesterday, though, felt, who knows if that was the bottom, but sentiment wise, I don't know if you guys agree, but sentiment wise, it felt pretty, I don't know how it could get much lower. Right. And so the old contrarian in me just is like, interesting, all the stories about the death of Bitcoin and all the reasons not to hold it and yada, yada, yada. It feels very reminiscent of the other times that they've said that as well, but it definitely feels like sentiment is completely washed out. Who knows? We could go lower. Today it's rallying a lot, but look, we've said this many, many times. If you're going to be a holder in this asset class, position it in a way that you can stand it, because it's very, very volatile. It's extremely volatile. Always has been, always will be. And you don't get some of the high returns without high volatility. Like, there's no free lunch in investing. And these are one of those times. So, and speaking about dated, this chart was, I want to say it was from Monday, maybe Friday, when Bitcoin was in a drawdown of 35%. Of course, it got down to, I think, a little over 50% yesterday. But this from Bespoke Investments, just showing that that's actually totally normal. It's done this many, many times in the past, and actually had bigger drawdowns than this in the past. So a lot of the people that have held Bitcoin for a long period of time know that and understand it. And it's just, par for the course. So, but remember these times when you're feeling FOMO on the upside, which was not that long ago, and you want to have it positioned correctly. I couldn't find the source article, but do you guys remember the guy that was a graduate, I want to say of Harvard or Stanford, And this is back when Bitcoin was like a little over 100,000 and it was going up. And the guy was like 25 years old, and they interviewed him, and he's like, yeah, I took my $100,000, I turned it into 400. So then I convinced my parents to give me their retirement money. And he put it like 50% in MicroStrategy and 50% in Bitcoin, like right at the top. And it's like, okay, that's to me an example of like you're going all in on something, no matter how convinced you are that that is the right move. The market, it continues to humble us, no matter what asset class you're in, and going all in like that is just insanely risky, especially with money that isn't yours, / might not be able to, you don't have the time to recoup it. If you're 20 years old and you just put, $10,000 into Bitcoin because that's all the money you have, well, you got the rest of your life to kind of recoup it, learn some lessons there. But taking your parents' retirement money, wow, I feel bad for that person. Hopefully they didn't stick with that trade. But
now, Chris, on this very show, we actually have username Bitcoin Blonski 67. And I just would wonder if he has anything to say about this chart. I'm sure you'll talk about it later too, Daren.
He had to mute himself. He had to mute himself there.
He can't. So he can't even. He can't even reply.
So this was from Jim Bianco. He had some good charts on this yesterday. The Bitcoin carnage is accelerating, down 12%. This was yesterday, of course. Now the fourth worst day this decade. The other 3 days were around something quote unquote breaking. So what is breaking now? In November 9th of 22, it was the FTX failure. In June 13th of 22 was the Terra Luna collapse. I remember that one pretty clearly. And then March 12th of 2020 was the worst of the COVID shutdown. So yesterday's sell-off was pretty major. But we'll see, yet to see anything big blow up. I know there were some rumors around that, but we don't want to pass around any rumors. We'll wait and see what comes out maybe over the weekend. A lot of, as viewers know, most bad news is released on Friday because we have about a 24-hour memory cycle and it'll be over by Monday. Sentiment indicators this week. The AAII sentiment indicator was at 39, so it continues to drop. Wouldn't be surprised to see this number go down again next week, given that they're released on Thursdays. Markets rallying today, though, so who knows? But yesterday was a pretty rough day in the markets, kind of across the board. And so we've got an uptick in neutrality and a downturn in the bullishness. The CNN Fear and Greed Index dropped down to 33 fear. It was all the way up at 60 greed 1 week ago. So that's a pretty big swing. And then Bitcoin was at 12 extreme fear, down from 16 extreme fear. So down in the teens. And that's typically, washout sentiment. We actually started the week with some pretty positive news, you would think. The ISM Manufacturing Index topped 52.6. And that is the highest since August of 22, and the biggest increase since June of 2020. That's the second biggest jump in the past decade. Now, the 50 number is key here because beyond 50 is expansionary, and below 50 is considered contractionary. And so we saw a big jump in the manufacturing PMIs on Monday, but the market didn't seem to respond to all that positively to that. And this is one of those things where you would think, hey, isn't all this spending on manufacturing, isn't that a good thing? Well, from a market's perspective, it has not been. Interesting. We saw huge announcements from Google or Alphabet and Amazon in terms of their CapEx, and I think Microsoft too, or maybe it was Meta. I can't remember what the third one was, but humongous announcements in terms of the billions that they're going to be putting into data centers and the infrastructure build outs. And I would encourage anybody that wants to know more about this to look up a researcher. His name's Kai Wu. And Kai has done some work around the investment returns when there's a high capex spend. And spoiler alert, it's not good. Like Warren Buffett used to say all the time, you want businesses that have that don't have a huge capex spend. It makes them easier to maneuver. Their margins generally are higher, etc. When you get all that money tied into something that is physical, if the environment changes, it's really tough to change that investment. So you're better off to have something that's more ethereal, like an idea, or an infrastructure that can be quickly and easily changed, rather than something physical. If you think about it, you put all this money into a big plant, an AI plant, let's say, and suddenly, there's a new thing that comes out that makes that plant kind of irrelevant. Well, you can't redirect those resources very easily. It's in brick and mortar suddenly.
Look at Meta in the metaverse, Chris. I mean, $73 billion, right? It seemed like, I don't know that anyone ever believed it, but Mark Zuckerberg clearly thought this is the future, is that we all will be virtually interacting with one another and we'll have no legs. And we'll be floating around and making our own avatars. And that's, if that was the future, man, that's a great investment. And now they shut the whole thing down.
Yeah. It's kind of surprising how much money they've lost and yet continue to be such a juggernaut, and their margins remain so high. But the market's kind of treated the companies differently. Google sold off initially, or Alphabet sold off initially on the news, but ended up yesterday really kind of, meh. The market didn't seem to care that much, whereas the market's really punishing Amazon, at least so far today. We'll see if it ends up that way. They just announced this last night. It's recovering a little bit from where it opened. And then you've got Microsoft, has really been hit hard. I think that's a little bit more tied to its ties with OpenAI and the overall sell-off in the software stocks, the small software stocks, which I could be wrong, but my sense of it is that a lot of that is tied to Claude. Daren, you guys might know more, but it seems like Claude, whatever they release with their open source and new apps and stuff, it's like a lot of software is going to be, maybe we don't need it anymore because Claude can just do it. Is that kind of what is being baked in here?
That's certainly what they're selling.
That is what they're selling. But in fairness, the things that I personally have been able to do with Claude versus 6 months ago is insane upgrade. So, I think, of course, in order to keep the feast alive, they got to keep talking it up, right? But I think that there's some pretty impressive things that these AI models are doing now. And I think I'm going to talk about that in my segment, but I think the whole market is adjusting to the possibilities of the things actually we've been saying for a while now. Last spring, when I really started diving into this, I was just like, oh my goodness, this is going to create so much change so fast. I don't think we're ready for it. And now we're starting to see some of that. And I think the market is now starting to digest that possibility.
Totally agree. And I think it regardless of what is happening, with all the volatility in precious metals, Bitcoin, the momentum stocks, the U.S. Stock market in general, all of that volatility is telling you something is changing, right? The market regime of the past 10 years is probably not the market regime of the next 10 years. And we're seeing some of these big shifts. Like I think this was Wednesday that this was generated, maybe yesterday. Value stocks had their best day relative to momentum in over 5 years. So the last time that the value stocks had this kind of beat was on the vaccine day in November of 2020. And so we're seeing these big spikes. There's been a noticeable shift in in the performers of the market, where now you've got a lot of the Mag 7 are actually negative on a year over year basis, while all the boring small companies, medium companies, all the boring stocks that kind of were left for dead have been doing very well, especially the small and medium stocks so far this year have been doing well. So we'll see if that continues. I mean, guys, it's been so long since value has led that, and it's happened so many times with these head fakes where, let's save the party until a few years from now, right? When the trend is solidified, hopefully. But we got these. Now, what are going to be the knock-on effects, or what are the possible knock-on effects of this tech sell-off? When you look at the software debt, is the biggest decliner in the U.S. leveraged loan market. We talked a lot about some of the experts in credit, like Jeffrey Gunlock from Double Line, have been warning for several months now that private credit is a disaster just waiting to happen, and that people should be very careful. And we've started to see some of this playing out, where a lot of these loans were made to these software companies. Now the software companies, their future is in jeopardy with some of the new technology that's coming out, and that is playing through into some of the private credit. Now, one thing about private credit is it doesn't get marked to market very often, so you don't really know what the prices are. I think it was last week or the week before we talked about BlackRock coming out and saying that one of their private credit funds was just marked down 19%, I think it was, in one day. They're just like, hey, actually, this is worth 19% less. But so you don't have that level of transparency with private credit, but you can see some of these, what they call BDCs, business development companies, that are publicly traded, what's happening with their stocks. And these are some of those stocks that are publicly traded. And you can see this is over the last year. And the one that's kind of hanging in there, that New Tech One, just in a cursory reading, they do a lot of lending via the SBA. So anybody that's ever tried to borrow money from them knows it's probably safer. I'm surprised they lend anything at all. Those are jokes. We always have to be careful with what we talk about here, because it has to be sourced, it has to be accurate. So we want to make sure that, I guess, we got to announce our jokes. But anyway, back to the stocks. If you look at how are these stocks performing, well, maybe their loans are not getting marked down, but the stocks, the public market is definitely saying, hey, there's something going on here. Now, so that is the private market. Shifting for a second to the real estate market. I think you guys remember us going through the month's supply of new homes versus existing homes, and how we had talked about the new home supply was up over 9, and while the existing homes was like 3 or less, and that traditionally has been a foreshadowing of what prices do in the future. Well, here we are, this from Hedgeye, showing the new construction premium vanishes. So prices for new homes sink below existing homes for the first time. So there used to be a premium on new homes, which makes sense, right? It's all things equal, you'd rather have a new home than a used one. Well, that is no more, and that's because the supply of those new homes has been higher. So supply and demand, possibly the oldest principle in economics there is. There's more supply of new homes on the market, which has dropped the price, and therefore there's no premium really. So interesting seeing that playing out in the markets today. This is that home supply chart that we had taken a look at. Now, New home supply has dropped down to 7.9. So it's dropped down a bit, but you see there where it got to maybe like 11 about a year ago. Meanwhile, the existing homes month supply is still under 4. And so if we're looking at this a year from now, it wouldn't be surprising to see that new home premium continue to fall, and the prices on the existing homes continue to stay relatively flat, given that supply. Now, there's not as much demand today because of interest rates and down payments and all that. So there's the other side of that equation to factor in as well. But when you just look at the month supply, this is really one of the first times in history of this chart, at least, where we've had such a huge difference in the supply of new homes versus existing. And this is a big reason why. When you look at this from Resi Club by way of Lance Lambert, he says, Lance says, housing's quiet shock absorber. U.S. homeowners at large have a giant equity buffer this cycle. 76.7% of all U.S. mortgages have a loan-to-value ratio of 60% or less. At a 60% loan-to-value on a $400,000 home, that would mean about $240,000 owed and $160,000 in equity. So a lot of folks are sitting on equity and don't want to move. They're also sitting on low interest rate mortgages, don't want to lose that. And so the housing market kind of continues to be kind of locked up from that aspect. All right, so where are we over the last year? Tracking some of the changes and changes in leadership in the markets here. I think the big story so far over the last, really call it since the tariff tantrum, is in the U.S., the small stocks outpacing the large stocks for the first time. Some of the shine coming off of the Mag 7. And some of that narrative has started to shift a bit. I still think that the international markets performance has not really been recognized by most yet. I think most people are looking at it as like a blip. Maybe it is, but not getting many questions about it from clients yet. So I think that as usual with these types of cycles, it usually takes a few years before the narrative shift catches on and catches up to the price. Like Daren says, the price is is what the market says the truth is, right? And then the narrative catches up to it later, and I think that's gonna continue to be the case. But when you look over the past year, the small stocks are keeping pace with the S&P, keeping pace with the mighty NASDAQ. And both of those are getting eclipsed pretty heavily by the emerging markets and developed markets.
International and bonds and small cap are finally having a moment. And Chris is sitting here like, see, anybody? Does anyone? Guys.
Does anybody see this? Yeah. Well, it's earning, at least now, what's interesting about it so far is, at least in the U.S., a lot of it has been earnings driven. This from Mike Zaccardi and Augur Infinity, showing the market share of the top 10. So think of this as like the Mag 7 plus a couple. Their market share got up over 40%, which was very high relative to history. Concentration, we had talked a lot about that at the time. But the earnings share was also fairly high. But when you see what the earnings shares, forward, there's the trailing in blue. And then you've got the forward earnings, looks to be, who knows, flattening out. Who knows if that's actually going to start heading the other direction or not, but it is flattening out a little bit. Now on the international side of things, what's interesting, according to Bob Elliott at Unlimited Funds, is a lot of that performance has actually come from currencies. So the weakening of the dollar relative to those other currencies, and multiple expansion. So it actually hasn't been per se that the earnings have gone up. It's that people have been willing to pay more for those earnings, which we had many years of multiple expansion in the U.S. And then the earnings kind of caught up to it. So that could be the market, anticipating those earnings turning up. But so far, the earnings haven't really even come through on the international side yet. It's just been multiple expansion and currency changes that have driven that. Now this is from Eric Bosmagian at EPB. The labor market remains soft in a low hiring state. The layoff rate inched higher in December. So we're getting some, labor numbers, and all the advancements in AI can't be helping this. So it's a big challenge, but I think a lot of the like the so what for the market is that, one, people get a lot of their spending from their jobs, obviously, but I think probably an even bigger factor right now is the asset, the wealth effect, the so-called wealth effect of essentially I think it's the top 10% that we've shown in those past charts that really account for something like 60% of the spending in the US. So while jobs are important for the spending in the economy, I think they're probably a second place to what's going on in the asset markets. And maybe that's why we have not seen the asset market sell off with the weakening in jobs. But I think, as Daren will probably show through some of the charts, the market action has been kind of pricing in a slower growth environment, which would make sense for the shift in interest rates going down, the shift between growth and value within the stock market. Those value stocks tend to pay out sooner than the growth stocks, which tend to be longer horizon payments. And so in a slower growth environment, that's kind of those are the assets that you would kind of expect. With those jobs numbers, we inched up on the possibility of a rate cut in March, according to the CME FedWatch tool. That inched up to a little over 20% yesterday, with some of those labor numbers, because remember, the Fed has the dual mandate of price stability, aka keeping inflation down, fighting off deflation, but also full employment. So the labor market is a big piece of the Fed's mandate, and so that should give that possibly could give reasons for a rate reduction. There's a 20% chance for the March meeting. So some changes there. All right, that's it for the for those slides, guys.
All right, we're going to start off on my end, Dano. I'm going to have you pull up the S&P 500 here. All right, so if I had to summarize this week in its essence, this is the S&P 500. This is the largest 500 US-based stocks. Often uses when people say the market, they're talking about the S&P or the Dow. Market's vastly bigger than that, but that's kind of what people think about when they think about the market. They often compare their portfolios to the S&P 500. If I had to categorize what happened this week, it would be a growth scare. So we're seeing a nice bounce here on a Friday. I'm really watching this closely to see if it bounces above this 20-period moving average right here. As Chris said earlier, like the market does what the market does, and then we fit the narrative to make sense of it. And but we're coming right up under that really important trading daily average. If we close below that, that's often a sign that things are weak. We saw that close below that early, or I guess on the 21st of January. It looked like we were going to go back above it, and then we came back down in. So I'm seeing weakness in the market overall. I think right now we've got a little bit of that growth scare that I was talking about. We hit that all-time high, pretty much worked our way down from there. Year to date, we're actually, as of the close yesterday, we were in the negative for the year. Although we'll see how we close out here at 1 o'clock. After 9:30 on a Friday, I'm not reading the signals until I see the close at 1 o'clock. People will position. So a couple things that we saw this week that were really big. Gold actually had its biggest single day drop since 1983. And you can see that drop here. So we haven't dropped gold that hard since 1983. Pretty crazy. And silver had its largest daily decline, intraday decline on record. Never has dropped. So folks, you saw history this week in the precious metal markets, namely in silver, and it's been a long time since we saw a close like we saw in gold. Chris and I always say, if you stretch a rubber band one way and you stretch it back the other, it's going to snap back. And when silver went up so quick and then back down, looks like it's holding support right here at $64 an ounce. And we're going to close up a little bit higher this week. Generally, I would look at that chart and think we're headed back down. I think it would be surprising if this one started trading back up in a really aggressive way. I'm bearish on silver, bearish on gold at this point. I think they've moved too fast, and I think it's going to get harder to move that up. And I think there's a lot of people that started unloading up there. There is lots of rumors going on out there that the banks were blowing up because of their positions on gold and silver, and that there was some financial engineering happening this week to help mitigate some of that. Who knows? What is oil saying about what's headed our way in the Middle East? So we talked about this last week, this build in the price of oil suggesting that there's something heating up out there. That continues to look like we're going to go higher in oil. Watch the headlines over the next day, next 48 hours as it relates to Iran. It looking closer and closer like we're headed to some kind of military exchange there. And oil certainly seems to be whispering that. If things were going to calm down in the Middle East, I'd be seeing the chart a little bit different, and I'm not seeing what I would want to see to say, oh yeah, things look like they're going to get better in the Middle East. I don't see that right now on the chart. And you can see that here because there's like this double top. Let me get, so I don't want that one. So we would be basically running like a double top here if we were going to see, so it would have like this motion here. I'm trying to get another indicator here to use. Let's do this. Okay, so a double top would be something like this. We would go down here, we would go up here, we go down here, and then we would break below this area here, and that would be a double top. That would be telling you that things probably are going to calm down in the Middle East. Charts are saying that is not the case right now. So let me show you something else that's interesting, and this is a triple top in NVIDIA, which we're watching closely because there's such a big concentration of the overall market. And it looked like that triple top was going to break down, and then we got this huge green candle. I really want to see this close today. It was looking lights out for NVIDIA last night. That might be shifting a little bit, and we'll see shortly. So there's this kind of growth scare in the economy going on right now. If it was the inflation fear trade that we've been seeing, we would be seeing stocks down and yields rising. But yields started falling this week, which tells you that stocks down and yields rising and yields falling. That's the growth scare. That's, oh, wait, maybe things are actually going to slow down more. Certainly, the political parties that are not in power would love to walk into the midterms with an economy that is not doing well. That would help them, but not too awful, because those who are of the party that are not in power, they don't want to get kicked out too. So it's kind of just balance.
One thing to add on that too, Daren, is what's interesting about markets is it wouldn't even have to be an actual slowdown in growth. It just needs to be less growth than was already priced in, right? So the market always works off of relative changes. So rewind back to when everyone was expecting so much growth. That was priced into the markets. And if we don't get that growth and we just get less of it, we still have growth, but we don't get as much as expected. That can be, the market is it's a relative game.
Well, so that's part of the issue that you're seeing in these AI stocks are priced to perfection, right? Like they're just priced to be perfect. And so if we don't get perfection from them, like we're starting to not see from Amazon and others, the market's going to beat them up. They had great quarters, but it wasn't a perfect quarter. And that's proving to be pretty painful. And it was Amazon's earnings. They weren't awful, but they weren't perfect. And now the market says, oh, if you're not perfect. One of the areas where we're seeing a pretty significant deleveraging, right? So over this last week, we heard about gold, we heard about silver, we had Bitcoin, we had de-dollarization, and now the market's saying, hey, hold my beer. Like, maybe we're not de-dollarizing. Maybe not everybody's going to gold and silver. And Bitcoin, the famous, preserver of wealth, is actually starting to look a little bit more like a leveraged tech trade, and just getting absolutely destroyed this week. I think yesterday was the first day ever that we had a $10,000 down day in Bitcoin. So for those trying to argue that Bitcoin is less volatile and a maturing asset, they're full of it. Not happening yet, at least. But we're seeing a nice bounce, 12% update so far. I actually kind of like this area for a short-term bottom for Bitcoin. A lot of people calling for the end of the world when it comes to Bitcoin, but there's a lot of support right around in this area. So I think it's going to have to work through that area to go a lot lower. And you can see this big green candle, which is often a sign of at least a short-term bottoming. And I would expect this to trade up into, the 77 range. There's definitely a lot of resistance now up in the 80 range as well. So we'll be watching that closely. But yeah, rough week. So if I'm going to wrap up the week in just kind of a bullish and bearish setup, I'm going to say GDP still tracking at 4%. ISM manufacturing, it looks like we're expanding in manufacturing. Services is looking steady. The corporate earnings are mostly beating, right? We're seeing corporate earnings come in pretty strong, and the Fed still has not cut rates. They've got room to cut rates if things start getting ugly. If I'm going to go on the T-chart and say what's bearish for the week, I'm going to say, hey, layoffs are the worst since January of 2009. So that's a long time. We haven't had layoffs like this since the 2008 crisis. We're seeing a lot of that. We're seeing job openings at the lowest since 2020. The ADP report for jobs, only 22,000 private jobs were added. There's massive AI spending with an unclear AI, right? So all these data centers being built, and you saw this happen a couple of weeks ago where ChatGPT said, hey, we're going to start advertising on these AI bots. And so nobody's really figured out what the economics of this crazy investment are. And then we've got Warsh now as a hawkish Fed president. So we don't really know how that plays out, and things have to kind of shift because of that. Underneath the hood, if we're really dissecting that, you've got this labor market that's weakening. It appears to me that, and I think a lot of people are unwilling to admit this, but at least AI is starting to take entry-level jobs at this point. And that's something that'll need to be watched. Well, I'm going to leave it there for the week. Hope everyone has a great weekend, and we'll be back next week to brief it up, talk about the markets.
Thanks for checking out the show. Thanks for checking out On the Markets, Fermata Advisors, Sonoma Wealth. You can learn more about our private wealth brand at sonomawealth.com. Wherever you found the show, make sure to subscribe. So whether it's on YouTube or Apple Podcasts or Spotify, we would love the subscription, and you will get that way you won't miss future episodes. We will see you next week when we go On the Markets.
You're up to date with Fermata on the Markets. Learn about how the Fermata Advisors family of brands can help your family and business in finance. Sonoma Wealth Advisors, a comprehensive, holistic finance solution offering financial planning, asset management, and tax planning. Take our free wealth analysis now at sonomawealth.com. Fermata 401k, business retirement solutions for small and large companies with a fiduciary commitment. Learn more at fermata401k.com. Fermata Tax, personalized tax services for yourself, your family, or your business with an emphasis on efficiency. Find out how at fermatatax.com. If you haven't already, like and subscribe to Fermata on the Markets on YouTube, Spotify, and Apple Podcasts. Fermata on the Markets features human hosts, editors, and voiceover talent. Music by Dr. Delight on Soundstripe, voiceover by Joan Alloway Nash. Thank you for listening to the very end. We appreciate diligent viewers and listeners. Fermata Advisors LLC is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempt from registration requirements. This content was produced by Fermata Advisors LLC, DBA Sonoma Wealth Advisors, DBA Fermata 401k, DBA Fermata Tax. The opinions expressed by Fermata Advisors LLC on this show are their own. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers and listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.